Hello, welcome back. So in today's video, I'll be talking about undervalued stocks in this overvalued market. So in today's video, we'll be covering a few things. We'll be covering the undervalued stocks in this market today, Apple's event, as well as some questions that you guys have left me in the comment section below. So let's talk about the undervalued stocks in the market today. And the first stock that we'll be covering is LVMH. So LVMH is a stock that is down 25% year to date and is currently trading at an 18 times earnings. And for LVMH, it has a lot of different brands over here. It's basically a conglomerate at this point. So you have brands like Celine Dior, you have Baluti, you have Loro Piana, Givenchy as well. All these different brands under one company, which is LVMH. So for LVMH, the entire luxury segment is facing headwinds. So you're seeing tariffs and China economic slowdown as well. And the company is facing some form of cyclicality as well. And we're seeing normalizing of earnings, especially since post-COVID. So post-COVID, the company had a surge in earnings because people could spend as stimulus money, and currently we're normalizing, so the growth is slowing and becoming negative last year and this year as well, and that is hurting the stock price as well as the fundamentals of the company. But for LVMH, this is what they're doing. They're trying to increase their sales and marketing to push it out to more of the masses, which is what Nike is doing as well. So LVMH is the sponsor of F1 and they sponsored the Olympics event last year as well. And I expect them to continue increasing their sales and marketing, which is what the management has highlighted. The management previously said that sales and marketing is important for them to push the brand out to more people and out to more eyes. So for LVMH, this is a portion of the business that no one talks about. So LVMH is actually a real estate company as well. They have a substantial amount of real estate in their book. So for LVMH, if you were to sum up all their property, plant and equipment, it's worth around $50 to $70 billion at market value today. So this is a portion of the real estate that they own. They also have leasehold real estates, which are not included in here. And for LVMH, it currently has a $270 billion market cap. So $70 billion is already hard real estate assets. So that is already a 25% insurance on this company. So for LVMH, currently now it's trading at a price to book of 3.47 times, which is historically quite low. The P ratio is at 18 times and the forward P ratio is at 19 times. So Wall Street is basically expecting that LVMH will have a negative year this year, similar to what they had last year, which I expect as well. But if they can show growth again this year, then this company's valuation at an 18 times earnings for a high quality business like LVMH is quite compelling. So for LVMH, the headwinds are your continued China weakness leading to lagging sales, economic depression hurting their earnings, as well as the lowering of their luxury brand and increased appeal to the masses. So LVMH is increasing advertising to the masses and that could weaken their pricing power and weaken their brand as well. So for LVMH, this is my summary. So LVMH is trading at the lowest valuation in a very long time. Luxury growth rate is supposedly going to be at around 6% all the way until 2030 and 2031. So assuming LV grows at 6%, with a 2.5% dividend yield and some multiple expansion, this could easily be a 12% return for this stock. I'm waiting for lower prices or reading up on this company. It's currently now presenting a decent opportunity in an overvalued market, especially since the market rebounded quite sharply since the April lows. So the next stock that is quite compelling today is United Health. United Health is a company that is down 40% year to date. And for one of the largest Dow Jones companies to be down 40% just this year is quite remarkable. It's currently trading at a 12 times earnings with a dividend yield of close to 3%. So for United Health, here are some of the risks with the company. United Health is in a sector that is extremely risky with healthcare. The company is under regulation scrutiny as well for their alleged fraud activity, and the CEO just got fired after setting the company up for trouble. So basically what the CEO did was he took in a lot of low quality clients to bump up the top line. But for insurance, when you do that, it is a risky bet because it will hurt your bottom line in the long term. You're basically taking on more risk for more revenue growth, but in the future, your bottom line will be hurt, which is what United Health is experiencing today. And that is why he resigned just a month ago. So for United Health, just off of their fundamentals and metrics alone, the company is amazing. So if you have to look at their revenue growth over the past few years, it has always been a stable 8 to 10%. And their metrics overall are incredible as well. So ROE at 22%, ROIC at 12% is quite remarkable for an insurance company. And across all your insurance companies and all your different other healthcare companies, United Health's metrics are one of the best out there. So for United Health, it is currently now probably one of the best undervalued plays. They have their earnings coming up on July 29, and I expect the company to issue very weak guidance because they want to lower the expectation for the new CEO to come in and for the new CEO to basically beat every single earnings. The stock could react negatively, but you never know. The company is strong and it is undervalued today. So I think it's a decent opportunity, especially in this overvalued market today. Next stock is Occidental Petroleum. So this is a very special one. It's a deep value one. So Occidental is currently down 12% year to date, and it is one of Warren Buffett's biggest holdings. So for your oil prices, the oil prices have been depressed over the past 3 years or so. So for Occidental Petroleum, they're one of the highest quality oil companies out there. So the way for you to judge an oil company is by their net profit margin, the ability to dig up oil at the cheapest price. And for Occidental Petroleum, they're the one that is able to do so at the cheapest price. So Occidental Petroleum had a net profit margin of around 16% in 2023 as compared to all your different other companies over here. It's one of the highest profit margins out there. So for Occidental Petroleum, they designed their own proprietary technology to dig up the oil, and one possible play for them is to license out that technology to all the different other companies. I don't think they'll be doing that. I think they'll be continually leveraging on that technology to lower their oil prices and lower their break-even costs. So for Occidental Petroleum, the break-even cost is at around $40 to $45, and currently with oil at $60, this company will likely have decent earnings this year. With all that being said, why am I not touching oil companies? So oil companies, their profits are tied to oil prices, which is dangerous and speculative. Oil prices, they tend to go up when there's global tensions and when there's economic growth. But on the other hand, when you see economic downturns, oil prices will tank. And in 2020, for example, your oil prices, they suddenly became negative because there was no storage space for all these different oil. So for these companies, they provide the highest upside, especially if there's deep value there. So Lilu, for example, the Chinese Warren Buffett, he had an oil play that was 100x in 1 year alone. He bought a Russian oil company that was selling at 50 cents for every single dollar, and he managed to 100x his money in 1 single year. So for oil plays, they are generally speculative in nature, and unless you can find a really deep value one, I would avoid this industry. Next portion, I'll be talking about Apple's event. So Apple's event summary is something like this. They had multiple different things. They were very focused on improving the user interface. So for Apple, they also had this AI function as well, which is to use ChatGPT for image generation, which is quite bullish for Apple. But apart from that, there wasn't much AI talk. So the AI features that they came out with was this access to AI, which is your foundational models framework, whereby people can basically access the large language models that Apple is using. And then you have this other portion as well, which is your Gemmoji using AI as well as Image Playground for image generation. So for Apple, this is my summary for the company. The valuation is high, the AI story is weak. Apple is more focused on improving the consumer interface and to create growth for the company. If you have to look at the reinvestment rate, for example, the reinvestment rate is at a low single digit. So the story for Apple today is simply just buybacks and buybacks. And it's great for the consumer that they're doing this to improve the consumer interface as well, but it is poor for an investor today. So currently trading at a 31 times earnings, I think there are better opportunities out there, especially amongst your Max 7 companies. I think Google, Amazon, they're providing much greater upside as compared to Apple. So for me, Apple is a stock that I would avoid today. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one, it says, buy Palantir, I rather overpay for Palantir. So Palantir is a company that's trading at 550 times earnings. And currently now the valuation simply doesn't make sense. So I did up a bit of valuation for Palantir. So assuming Palantir has a 50 times earnings in 5 years time, and assuming the company only grows at 40%, the company now will give you a negative 10% CAGR for 5 years in a row. So let's bump up the price to earnings ratio. Let's say the company trades at 100 times earnings, and let's say the company grows at a modest 40% for the next 5 years, you will get a 3% return for Palantir at current prices. And this is the price that it was trading at just a few weeks ago. So currently now it's trading at $127. So for Palantir, it's more of a speculative stock. I think it is beyond the realms of a value investor to invest in Palantir. It is a stock that is built around narratives and stories rather than the actual fundamentals. So for me, I think Palantir is a retail stock that has worked out very well. But for me to be ever interested in this company, I need this stock to drop down to 50 times earnings, which is impossible at this state. I mean, unless the company goes bust, I don't see it dropping down 90% all the way until 50 times earnings. So for me, Palantir is an avoid. You can overpay for Palantir, but may the markets be with you. Next comment that I saw is quite an interesting one. So this one, he said, in some of your videos, you've indicated that overpaying for compounders, top quality companies is not a problem, but yet you're hesitant to buy these companies at current prices. Like Amazon, when it still looks cheap when you measure their PE and compare it to the 10-year period. Same for Visa, Microsoft, you seem to be afraid of the short-term pain, the potential price drop after you buy, but in the long term, it shouldn't matter that much. So how is it ultimately? So this is my response to this commenter over here. So I said, thank you for your comment, but investing is a lot more nuanced. In an ideal world, I love to buy companies like Visa, MasterCard, Microsoft at fair values and basically equal weight them and ride them for decades. But investing isn't as black and white as that. So there's always opportunity cost, and even when a business is top tier, it's about capturing the best perceived return for the money I invest. So I've always said that slight overvaluation isn't a problem, but in certain cases like Microsoft and Visa, for example, the two companies that are simply trading out of my comfort zone in terms of the valuation itself, and there are simply better opportunities out there. So I think Amazon is a better buy right now as compared to Microsoft and Visa. Microsoft and Visa's their valuation today is simply a bit too overstretched. It is out of my comfort zone. And you have other companies coming up as well, which are quite high quality, like LVMH, WooCorp, all these different businesses. And for me, it's not about fear of short-term pain. It's about putting my money where it works the best. So for me right now, I think the best upside in terms of your Max 7 companies and in terms of my entire portfolio is in Amazon, Google, as well as United Health. So buying Visa and Microsoft at today's prices as compared to all your different other opportunities today simply doesn't make sense. So I would love for these compounders to be fairly priced at any given time, but unfortunately that's not the case in this market. I hope you guys have found this one useful and invest safe.